In this video, I'm going to tell you how I go ahead and select my stocks, how I predict direction a large percentage of the time. Now, to give you an idea of this, over the last year and a half, 2 years, the stocks that I have selected, you can see the total P&L is about 465%. Just FYI, this is different to trading performance. The goal of this is to beat the S&P 500, or if you're in FX, basically beat the benchmark of what the market is. Essentially, trying to beat the market. And when you add trading tools like timing and stuff on top of this, it can actually improve this by a significant margin. But it's just to give you an idea, and obviously past performance is not a reliable indicator of future results, but it just gives you an idea. Okay, so anyway, how do I go about this? Well, let's first of all zoom out a little bit and understand exactly what the types of edges that there are to get with this type of an approach. And so first of all, we need to understand how things go. So typically, fundamentals, obviously, are going to be the things that are driving things. Obviously, no fundamentals, no people, no movements, right? So then we go into reflexivity, which is kind of linked with price. So I'll just put it as those two together. If you don't know what that is, it's really simple. It's basically the idea of if we have fundamental information, let's just say that company's going to go up, and then the company does go up, everyone can see that stock price increasing. And the fact that it's now trending means that people who are just looking at it technically will start feeling more comfortable buying it. And so in a way, price is almost the leading indicator of itself in some situations. And that's the key bit there. In some situations, people take that to the extreme. And then from there, we have the technicals, right? This is the flow of how things go. And as a general rule, this is the most predictive fundamentals. This is semi-predictive, and definitely edges can be made here. And then this is going to be pretty much entirely reactive. And so the best directional picks and the methods of picking direction that I've ever found obviously are going to skew more towards the left side of this equation. And if you think about why, it's pretty obvious. It's like if you're going to be making picks about whether something's going to go up or down, do you really want to do it based on something you've drawn on a chart and hope for the best? Or do you want to do it based on the actual understanding of what's going on and why? Now, you might be thinking fundamentals sound boring. They sound this, they sound that. But bear with me, I'm going to show you some very, very simple, high leverage ways to do it where you don't really need to be a fundamental expert and go through tons of financial statements at all. And so we'll get onto that as we go through it. So the first thing to understand, right, is the types of edges. So pre-inside info. This is going to be, if you imagine like an insider trader, someone who has knowledge about something that's going to move the market, and no one else knows about it. That's obviously illegal. Insider trading. It's illegal because it works. It's probably the best trading edge to ever exist, just factually, which is why it's illegal, because it's such an unfair advantage. That gives us clues as to, what some of the biggest edges are, because if we can take elements of that without it being illegal, that's going to be good. And so examples of this would be, let's just say that you are looking at Apple, right? And Apple have released a new product. And Apple, whatever that product may be, they've released it, and you start seeing evidence in the real world that it's taking up major adoption, right? Lots of people are buying it and using the product and loving it. It's gaining like a bit of a cult-like following, but most people who are analyzing it are still quite negative about it. That's going to be an example of people being aware of information, but not really internalizing it. They don't believe it just yet. They don't have that conviction. And so in a way, that's kind of a version of insider trading, because you are paying attention to something and giving it a really fair look before everybody else becomes aware of it. And so what does that mean? Well, it means that if you get in early, when that information does become obvious and people do catch on, you are going to have basically one of the better entry prices possible. That's going to be the first type of edge, right? It's the idea that you know something that the market either doesn't know, which is technically illegal, or something that the market is not giving enough weight. It's not giving enough feeling to it. And that could be for many reasons. It could be there's not enough people watching it to be able to notice it. So you'll find that's quite common with smaller stocks in smaller markets. Or it could be something like they are, not indoctrinated with that crowd. If you look at traditional investment analysts, they're not probably going to be following influencers on social media who are promoting a particular product, or weird little crevices of the internet that are growing before everyone else. Like, they're just not going to do that. They'll normally focus on other things. And then the third reason will be a lot of these bigger players are restricted in the assets that they can trade, and they also don't want to necessarily take these big risks because they've got too much to lose. They prefer to keep their jobs. They prefer to be safe. They prefer to keep investors happy rather than risk it all trying to be this kind of gun-ho trader. I think people have this perception of traders that they're just risking it all and doing all this stuff the whole time. Most of the time, they're not doing that. So something to keep in mind. So that's going to be the first one, which is pre-inside info. Call it what you want. This is just a name I came up with. Right, pre-inside info. Everything downstream from here is about accepting that everybody is looking at the same thing. So I like to call this second bucket, in fact, I'll just give it any name really, which is just traditional analysis. So these are going to be the types of people who are, if you're trading stocks, going through like company financial statements, people who are, going through, speaking to the founders, analyzing the supply chains, more of what you traditionally associate with fundamental analysis. This is going to be popular with both traders and with longer term investors, especially as well. And this is probably what most of us think of, as I said, when you think of fundamental analysis. I probably don't need to explain that all that much. But if you think about it in terms of this timeline here, if we just remove the Apple example and we think about, okay, how does things actually play out in reality? Well, let's actually break this down, because in reality, let's just stick with the business example. We know that businesses equal make money. What is the last sign that they've made money? That they've made money is the last sign. So why am I saying this? Well, it means that if you're looking at a financial statement of a company, for example, what you're basically looking at is the past, right? In the same way that technical traders will be like, look, we're analyzing the past to predict the future. It's actually very similar when you look at earnings of a company or whatever. It's the same thing. And so if we were to actually map out how things go, we have demand. So demand from whoever, whatever they're selling or the market they're trying to go after. Is that market like a strong market itself? And then from that demand, we'll go to purchases. And then from those purchases, obviously sales are made. And then if enough sales are made, we will see significant financial statement changes. Just change that there, statement changes. So obviously this isn't like the most perfect way of saying this, but hopefully it gives you an idea. Like, let's just say you're a big company. The first thing, like in a perfect world, that you're going to see is you're going to see like people actually buying the products. Like if you see people out and about buying and lining up for, a particular shop or whatever, and it's publicly traded, like that's going to be the first signal that something's happening, especially if it's repeating over time. And so traditional investment analysts are typically sitting right here for the most part. And that's fine. Nothing wrong with that. One of the beauties is that this can still be predictive of the future, because the markets are not just about pricing in what's going on now, it's about pricing in the expectations of the future. And what could make people more positive about the expectation of the future? Well, if the actual financial statements come out and they look really, really good, better than expected. These are, and we're kind of getting ahead of ourselves here, but these are the reasons why these types of analysis still exist, because they are concrete. You're not having to guess. The further left we go here, the more sometimes it can be more tricky to actually find and verify these things on a consistent basis, because you're not always going to have the ability to have an edge on the information, because you'll be edging more into like pre-inside info and stuff like that. But even if you didn't understand what I just said, just think about it like this. Traditional analysis is what it says in the tin. It's traditional analysis. From there, we have what I'd consider high leverage signals. So this is where I like to spend the most amount of time, because it's the highest leverage on my time and also one of the most consistent as well. So what does this mean for me? Well, what I'm looking for is I'm looking for an amalgamation of a few different analyses. Now, in order to understand which one of these I pick, we need to get very clear on something, because it's very easy when you get into this world to start thinking you need to look at everything, but you need to understand different factors have different time horizons that they're going to affect. For example, let's just say that I was a Warren Buffett style investor. Now, if you don't know, his whole philosophy is basically buy good companies at a deep discount. So let's just say that a company's stock is doing this. Warren Buffett looks at that, and if he analyzes the company, thinks that it's strong over the long run, probably minimum about 5 years, then he's just going to buy it because the current price is at a discount. Now, that's great for him, but as traders, that can be devastating, because if you adopt the same approach, that can mean that you have 3 years where you continue to go down. And if you're just buying, you're just going to get chewed up until either the account blows or you just lose faith in humanity and decide to just completely quit. And so what does this mean? Well, it means two things. The first one is that, as I said, certain metrics aren't as valuable. And so in this case, valuation is basically useless with short-term trading, because something can stay overvalued or undervalued for extended periods of time. This is the same reason why you'll hear people say all the time, like, don't try and fight the market, don't fight the trend. It's because those things can persist. The forces that are driving those things can and do regularly persist. And most of the time, it just makes more sense just to go with those flows rather than trying to fight against it and be, God's greatest gift to the planet. And so that's the first thing, right? Some metrics are more useful than others. So we'll put that under there. Some metrics are more useful than others. Now, to kind of go into a little bit more depth on this as well, just kind of tidy this up a bit. Other examples of things that I will look at. So momentum is important, but growth, so we call growth and profitability, are two big ones. Is the company making money? big thing. Ideally, is that growing in terms of is the actual revenue growing, showing the actual demand is growing, and are the actual earnings of the company themselves growing? Because it's possible to increase revenue and lose profit. In an ideal world, because there are so many stocks to pick from, at least, and you can apply the same sort of premise to whatever market you're doing. But in terms of stocks, obviously they're companies, so they want to make money. If it was FX, it's different. The company, the country is mostly, the currency, sorry, is mostly going to be driven by economic cycles, right? So macroeconomic factors, interest rates going up and down, all this sort of stuff. And by the way, that's a side note, if you're kind of debating about like, oh, what market like could I get the best edge in, honestly a large part of it is like what makes sense to you. Are you someone who really likes understanding how the world works? Are you someone who just likes, understanding, businesses make money, nice and simple? Can I just get a clear understanding of that? Whichever one you get a better understanding of naturally, it's probably a good idea to kind of follow that instinct a little bit. But yeah, growth and profitability, very, very easy to judge. Now, another one of my favorite ones, EPS revisions. So you can do your own research on this, but this is going to be a really, really key thing, because EPS revisions, there is a right and a wrong way to do this, but essentially it's the idea that there are institutions out there who are forced because of regulation to disclose things, basically their ratings and their predictions, their estimates for stocks. Now, not every stock has that much coverage, so you're kind of restricted to the slightly larger stocks with this. However, if you think about what this is actually achieves, it's massive, because you have analysts that are going over all of the traditional things when we think about fundamental analysis, things like supply chain analysis, various things like financial analysis, speaking to industry experts, all of the things that you would normally think of when you think about traditional fundamental analysis. All of these analysts are doing this for you. And because of regulation, they are forced, at least in the big players, because of conflict of interest and various other reasons, they are forced to share these with you, and so you can track the changes of them over time. This is not about me going, oh, I really like, Paul John from, I don't know, Boston or whatever. It's not that. It's not me picking my favorite analyst that I just really like the look of and the sound of. That's stupid, right? Instead, what it's saying is look, I'm going to take the aggregate, meaning like the average of all these people, and see, okay, well, what's going on over time? On average, if we if we map this onto a chart, we would see over time that, okay, analysts are kind of neutral, but then, oh, wow, like they've all started suddenly increasing it. They didn't do this for no reason. They didn't do that for no reason. They have gone through and done all the research. And so if lots of analysts are aligning in the same direction, it's the sign that that company is strong. Analysts are starting to believe in that company more and more. And what tends to follow, and you can look this up, this has been very well studied, that there tends to be a continued flow of momentum after this happens in a certain way. Specifically, just when it starts growing, the faster it grows, generally, the faster, more intense, and longer these like trends persist. But this is one of the easiest ways to skip doing all of this stuff, because you're relying on people who have gone and done all of the work for you. It is the definition of smart thinking. And in terms of where this is going to sit on the actual edge basis, this is going to be a high leverage signal approach. And so some metrics are more useful than others. These are the key things that I'm going to be looking at. I'm going to be looking, are they profitable? Are they making more money as well? So is the demand growing, the revenue? And are analysts increasing their revisions? They're all aligning in the same sort of direction. This is going to be probably the most important way to look at this. Now, luckily today you can achieve some of these things with AI. Which is nice, which is handy, but you really need to know what you're looking at. And so I don't want to make this like an ultra technical video for you, but you're more than welcome to go into and research these things if you want. If you just want to see me doing it for you every single week, you're more than welcome to join Inside Alpha. This is kind of what I showed over here. The watch list down there is something I share every single week, which will show you the exact stocks that have gone and passed through my process of this, etc. And I'll share how strong they are, roughly why I'm picking them, that sort of stuff as well. The second thing to keep in mind down here is about timing. So timing is going to be the area that most of you watching this are going to feel most comfortable with, or at least most familiar with, because timing is technical for me, for the most part. You can time fundamentally. I don't want to particularly. And so technical timing. And a large part of that is understanding the risk management structure that you want, what sort of win rate you want. And really it's just about understanding your personality at that stage. And once you've done the heavy lifting of like understanding what things are likely to go up, down, or in some cases sideways, then you've done most of the work. Like most people will spend their entire lives studying all of this stuff. And if you want to do that, great, you can do very, very well with it. But especially, by the way, one of the benefits is the biggest benefit in my eyes. I kind of touched on this earlier briefly. Briefly. With stocks, if you're looking for like where there are enough analysts covering it for it to be valuable, what I'm looking for is a minimum of 10 analysts covering a stock. in order for it to even pass me looking at it to begin with. And in order for that to happen, you're going to find that these market caps, they're large cap stocks, meaning they're big stocks. It's going to be different if you're in other markets. Like if you're in FX, it's massively spoken about, but it's a little bit of a different game. I can make a video on that if you guys are interested. But I'm mostly like stocks heavy these days. But yeah, minimum of 10 analysts. But in order for that to happen, need to be big companies. And so what that means, it means that if you don't have the skills that these analysts are actually using to come up with those ratings, then what it means is that the entire mid to small to micro cap stocks are out of your reach, meaning you can't really trade them because you kind of lose a lot of your edge. Yes, you can analyze the basics, like is the company growing, is it profitable? That's fantastic. And by the way, that on its own is pretty good combined with timing anyway. But when you add an EPS revisions as well, it basically accounts for all of your blind spots, things that you're not aware of, the complexities of each business that other people are already going into detail in and basically doing the work for you. But you are limited. You know, you're limited to the big cap stocks if you are including EPS revisions as part of your thing. Whereas if you were open to learning more about it, then it opens the door to basically trade a huge universe of stocks. But everything comes with pros and cons. Depends like how violent, you know, you want to, you know, increase the amount of money you've got, and there's other risks that come into it and all these sorts of things. But just to give you an idea, that's the general rule of thumb. And to give you a specific rule as well, I'm really looking for about 80% plus of analysts to be aligned in one direction. And the closer I get to that point where the actual percentage change is quite big, so if we go from like 80% to like 95% in 2 days, normally this is going to be around earnings. That's going to be a big deal, you know, because speed, the markets love speed, money loves speed. And so that's something to really, really keep in mind. But yeah, so in terms of timing, this is the big reason why investing is different to trading, because with investing, Warren Buffett is just happy to hold through all of this stuff in hopes that over the long run it should align. But you may be sitting through 2, 3, 4, 5, 6 years sometimes of price moving against you or almost seemingly randomly in order for things to make sense, which is why timing is so important. The way that I like to structure things is I will go through, I'll do my process, I'll create my watch list each week, I'll post it to the group. And then that's basically just the universe that I'll look for. I'll have a specific setup that I'm looking for, only on those things, which I'll manage most of the time just with alerts. It's very simple, can be done around a full-time job. Or if I want to trade it more intraday, I've got more time, I want to do it actively, then I literally just do the same thing on a slightly lower time frame as well. It's all very simple and systematic. But the reason that that works is not because, oh my God, I've mastered the perfect like technical entry and all this sort of stuff. It's just simple. Like I've just done the fundamental work. I've leveraged the fundamental work of a large group of other people, probably much smarter than me. And then I just use my skills of timing, which is not actually that difficult, to turn that into tradable opportunities. And then you just follow the basic principles of the market, which is just make more overall when you're right than when you're wrong. That doesn't necessarily have to mean a massive risk reward. It could just mean a one-to-one, but it could be how you manage your trade when you're in the trade. This is what I mean when I'm saying that when it comes to technicals and timing, everyone is always thinking that if I just get the perfect combination of technicals, then everything's going to be okay. And I'm not, I always make this clear in my videos, I'm not shitting on technical only trading. I was a technical only trader for a very long time. However, I've found that the superior edge is in doing all of this other stuff as well. And it actually makes the technicals much more enjoyable because it's much easier to hold on to trades when you know, oh, there's actually a reason why this should go up instead of hoping that it should go up. And it's something really, really important to understand. But yeah, so hopefully that makes sense. This is how I am predicting my direction. And just to leave you with a final note here, we have a 1 to 3 month time horizon. This is the time horizon that I'm predicting. Don't get me wrong, there can be stocks that every 1 to 3 months they just keep new stories emerge, new things developing, and so they just stay on and on and on and on for like a year. Very possible, happens a lot. However, it's still constantly rolling. I'm always looking at what's happening today and how is that going to influence the next 1 to 3 months. Because if I try and predict 1 to 12 months, there's so many things that could happen and will happen that are out of my control, out of my field of view, and so I don't bother trying to predict them. And the great thing about this is it's really simple, what I've just described. Like when you think of most like fundamental systems, it sounds really complicated, and for the most part, people do overcomplicate it, in my opinion. I much prefer highest leverage. I want to get the most result for the least amount of work. And I would think that you would probably want the same because it's actually the smart way to think. But anyway, hope you've enjoyed. Let me know. I'll also leave a link for a video right here on ways you can control risk in more creative ways that I pretty much guarantee you probably haven't heard before, which is talking about basically how you can separate your correlation with the market. So if you wanted to trade a particular stock and you buy it, people think, oh, well, if the company's good, it will go up. There's actually loads of other factors that are assessing that are affecting that trade and whether it's going to work. And most people completely neglect those or ignore them or don't know they exist, which is why most stock pickers are really ineffective, because they are judging it based on things that actually weren't to do with that stock moving or FX pair or whatever. They didn't take it into account. They didn't know how to hedge their risk intelligently. So if you want to check that out, I'll leave that on screen right now. Take care.